In business, cash flow is king, but protecting your assets runs a very close second. Imagine this scenario. You've supplied thousands of pounds worth of goods to a customer, a big order that you worked hard to fulfill. You've sent the invoice, but before you see a penny, you get that dreaded letter. Your customer has gone into administration or liquidation. Suddenly your invoice is just one among a pile of others, and your chances of getting paid in full are slim to none. This is a situation that can cripple even a healthy business, and it's one I've seen far too many times. It's a harsh reality of commerce, but it's not one you have to face unprotected. There are tools you can use to safeguard your interests. This is where a reservation of title clause, often called a Ramalpa clause, becomes one of the most powerful tools in your arsenal. It's a critical piece of legal wording that you should have in your terms and conditions of sale. Put simply, it's a statement that says you, the supplier, retain legal ownership of the goods you've supplied until you have been paid for them in full. Even though the customer has physical possession of the items, they don't actually own them. This simple concept fundamentally changes your position when a customer goes bust. It elevates you from being just another unsecured creditor waiting in a long queue for a few pence in the pound, makes you the owner of assets that are sitting in their warehouse. Think of it as a legal safety net. Without it, the moment your goods are delivered, they become the customer's property, and if they go insolvent, those goods will be sold off by an insolvency practitioner to pay secured creditors like the bank first. You'll be left with very little, if anything. With a valid ROT clause, however, you have the right to get your specific goods back. This isn't about getting a vague promise of payment, it's about reclaiming what is rightfully yours. This can make the difference between a manageable bad debt and a catastrophic business loss. It's a fundamental protection that every single business supplying physical goods on credit should understand and implement without fail. So, why does this matter so much? Because in the cutthroat world of business, you must control the controllables. You can't control if a customer's business fails, but you can control the terms on which you trade with them. A well-drafted ROT clause is not an aggressive tactic, it's a standard, sensible business practice. It shows you're a professional who understands risk. It gives you leverage and a clear course of action when things go wrong. Ignoring this is like leaving your front door unlocked. You're inviting trouble. Throughout this essay, I'll walk you through how these clauses work, the different types, and how to make sure they stand up when you need them most. Pay attention, because this is vital. Not all reservation of title clauses are created equal. They come in different forms, each offering a different level of protection, and it's crucial you understand which one is right for your business and your products. The most basic and common type is the simple ROT clause. This one is straightforward. It states that ownership of the specific goods you supplied does not pass to the buyer until those specific goods have been paid for. If you supply 10 pallets of bricks and the customer hasn't paid for them, you can claim back those 10 pallets of bricks, provided they are still there and identifiable. This is the bedrock of ROT protection and the easiest to enforce in a court. Next we have the all monies clause, which offers much broader protection and is the one I would typically recommend for most businesses. This clause is a significant step up. It states that you retain ownership of all goods ever supplied to the customer until all outstanding debts owed to you by that customer have been paid in full. Let's say you've made multiple deliveries over several months. The customer has paid for the first few batches, but not the most recent one. With a simple clause, you could only claim the unpaid recent batch, but with an all monies clause, you can claim back any goods you supplied that are still in their possession, even the ones they've technically paid for. until the entire account is settled. This is incredibly powerful. Then we venture into more complex territory with clauses that try to extend your claim. One example is a proceeds of sale clause. This attempts to give you rights over the money the customer receives when they sell your goods onto their own customer. So if your customer sells the bricks you supplied before paying you, this clause would try to give you a claim over the cash they received from that sale. I must be very clear here, these clauses are notoriously difficult to enforce in the UK. They often fail in court because they can be seen as creating an unregistered charge over the company's assets, which is a legal minefield. While they sound good in theory, their practical application is weak, so don't rely on them. Finally, there's the mixed goods clause. This is for situations where your materials are used in a manufacturing process and combined with other components. For example, you supply flour to a bakery that uses it to make bread. This clause attempts to give you ownership rights over the finished product, the bread. Like the proceeds of sale clause, this is another one that insolvency practitioners and courts are very likely to reject. Once your goods have been irreversibly mixed with others and have lost their original identity, your claim to ownership is almost always extinguished. Stick to what works. A robust all monies clause is your strongest and most reliable bet for real-world protection. Having a reservation of title clause in your contract is only the first step. When the time comes to enforce it, the burden of proof is entirely on you, the supplier. You can't just wave a piece of paper and expect an insolvency practitioner to hand over your goods. You need to build a watertight case, and that means providing clear, undeniable evidence. The first thing you must prove is that the ROT clause is actually part of the contract of sale. This sounds obvious, but it's a common stumbling block. You must be able to show that your customer was made aware of and accepted your terms and conditions before or at the time the contract was made. Simply printing them on the back of an invoice sent after the goods are delivered is often too late. The best way to ensure your terms are incorporated is to have the customer sign a credit application form or a supply agreement that explicitly includes or refers to your ROT clause. Another solid method is to include them in your quote and order confirmation documents, which are exchanged before delivery. Consistency is your best friend here. Every single transaction should follow the same process, so there's never any doubt that your terms apply. You need a clear paper trail showing the customer's agreement. If the situation becomes a battle of the forms, where both you and the customer have your own conflicting terms, your claim could easily fail. The insolvency practitioner will scrutinise this, so leave no room for ambiguity. Beyond proving the clause exists, you must then prove that the goods you are claiming are yours. This means you have to be able to positively identify them. If you sell generic, unbranded items like nuts and bolts, this can be incredibly difficult. How can you prove the bolts in their warehouse are the specific ones you supplied and not from a competitor? This is where good record keeping and product marking become essential. Using unique batch numbers, serial numbers, or even distinctive packaging can make all the difference. You must be able to match the goods on site with your delivery notes and unpaid invoices. Without this clear link, your claim is purely theoretical. Finally, you have to prove that the goods you are claiming are actually covered by the clause, meaning they haven't been paid for. If you operate a simple ROT clause, you need to link specific unpaid invoices to the specific goods you're trying to reclaim. This can be complex if the customer has a running account and makes regular non-specific payments. This is precisely why an all monies clause is so much more effective. With an all monies clause, you only need to prove that any amount is outstanding on the account to claim any of your identifiable goods. It simplifies the accounting enormously and strengthens your position immeasurably. In short, prove the contract, identify the goods, and prove they're unpaid. When a company enters insolvency, an insolvency practitioner, often called an IP, such as an administrator or a liquidator, is appointed to take control of the business and its assets. The IP's primary duty is to act in the best interests of all creditors, and they have to follow a strict legal hierarchy. It's really important to understand their role and the process they'll follow when you submit your reservation of title claim. Now, the IP is not your enemy, but they are in effect a gatekeeper. They have a legal duty to be skeptical and will not simply take your claim at face value. They're going to rigorously test its validity, because any goods they release to you reduces the pot of assets available for other creditors. So expect scrutiny and honestly prepare for it. The first step, as soon as you are aware of the insolvency, is to formally notify the IP of your claim in writing. Do this immediately. Your letter should state clearly that you are claiming ownership of certain goods under a reservation of title clause, and you should attach a copy of your terms and conditions along with a detailed statement of the customer's account. You should also request urgent access to the customer's premises to identify your goods. Time is of the essence here. The IP may be in the process of assessing the company's assets for a quick sale, and you really need to state your claim before your goods are sold or moved. Your initial communication sets the tone for the entire process. Once the IP has received your claim, they'll begin their verification process. They'll follow a procedure very similar to the points I raised in the previous section. First, they'll check if your reservation of title clause was successfully incorporated into the contract of sale. They'll look at the order process, credit application forms, and any correspondence. Next, they'll require you to identify your goods. Usually this involves a site visit, where you or your representative will walk through the warehouse, accompanied by the IP or their staff, to physically locate and list the items you are claiming. Bring your delivery notes, invoices, and any documents with serial or batch numbers to help with this. After you've identified your goods, the IP will make a final decision. They'll adjudicate your claim based on the evidence provided. If they agree your claim is valid, they'll arrange for you to collect the goods. In some cases, if the goods are essential for the IP to sell the business as a going concern, they might negotiate to buy the goods from you. This is a great outcome, as you actually get paid. If they reject your claim, they must provide you with a written explanation. At this point, your only recourse would be to take legal action, which, as you might guess, is expensive and uncertain. That's why getting your paperwork and evidence right from the start is absolutely paramount if you want to avoid that costly final step. Many seemingly strong reservation of title claims fail due to simple, avoidable mistakes. Understanding these common pitfalls is really the key to ensuring your clause actually works when you need it to. The most frequent reason for failure is the failure to properly incorporate the clause into the contract. Many businesses make the classic error of only having their terms printed on the back of their invoice. Now remember, an invoice is a demand for payment after a contract has already been performed. Legally, you can't introduce new terms at this stage. Your terms must be accepted by the customer before you deliver the goods. This is a non-negotiable legal principle that trips up countless suppliers. Another major pitfall is the inability to identify your goods. This is a very practical problem that can completely derail a legally sound claim. Imagine you supply a common raw material, like plain cardboard boxes or standard grey steel. Your customer likely buys the same material from other suppliers. When you arrive at their warehouse, you're faced with a huge stockpile. How can you possibly prove which items are yours? If you can't, your claim fails. You must think about this when you set up your processes. Can you label your goods? Can you use batch codes? Can you deliver them on uniquely marked pallets? If you cannot distinguish your property, you simply cannot reclaim it. A third problem arises when goods have been changed or used. If you supply components used in manufacturing, your ownership is generally lost once the goods are irreversibly altered. For example, if you supply liquid chocolate that is then baked into cakes, you cannot claim the cakes. Your chocolate no longer exists in its original form. The same goes for goods that have been fixed to a property. If you supply windows that have been installed into a building, they become part of the land. You must be realistic about your product's life cycle and understand when your protection ends. Finally, poor record keeping will sink your claim faster than anything else. You need a clear audit trail. This includes signed contracts, purchase orders, order acknowledgements, delivery notes, and up-to-date account statements. If your paperwork is messy or contradicts itself, the insolvency practitioner will reject your claim. They are looking for reasons to reject it. Don't give them any. A disciplined approach to sales administration is vital for asset protection. Treat your paperwork with the seriousness it deserves. The moment you hear a customer has entered insolvency, whether through a formal letter, a rumour from a sales rep, or a notice online, you must act immediately. Hesitation is your enemy. Every hour that passes reduces your chances of a successful recovery. Here is a clear step-by-step checklist of what you need to do. First, stop all further supplies immediately. Do not send any more goods, even if they are already on the lorry. If a delivery is in transit, do everything in your power to recall it. Under the Sale of Goods Act, you may have a right of stoppage in transit. Fulfilling any more orders for a company you know is insolvent is simply throwing good money after bad. Second, gather all your documents. You need to assemble your entire file on this customer. This includes the original signed contract or credit application form, copies of all unpaid invoices, the corresponding signed delivery notes for those invoices, and a full up-to-date statement of account. Make sure you have a copy of your terms and conditions that were in force at the time the orders were placed. Organise these documents logically and make copies. This is your evidence pack. You will need it to present a professional and credible claim to the insolvency practitioner. Being prepared shows you are serious and makes the IP's job of verifying your claim much easier. Third, write to the insolvency practitioner immediately. Do not wait for them to contact you. If you don't know who the IP is, you can find out from Companies House or by calling the customer's head office. Your letters should be clear and to the point. State that you are a supplier, you believe you have goods on their premises, and you are exercising your rights under your reservation of title clause. Formally demand that your goods are identified and separated from other stock and must not be sold or moved. Attach your terms and conditions and a summary of the debt. Request an urgent appointment to visit the site to identify your property. Send this letter by recorded delivery or a courier to prove it was received. Fourth, follow up relentlessly. Do not just send the letter and wait. Call the IP's office to confirm they have received your claim and to schedule your site visit. Be persistent but professional. Remember, the IP and their staff are dealing with numerous creditors and the squeaky wheel often gets the grease. If you have a sales representative who has a good relationship with the customer staff, they can be a valuable source of on-the-ground intelligence about what stock is worth. Your goal is to get your claim to the top of the pile and get your goods identified and returned as swiftly as possible. Swift, decisive, and organised action is what will win the day. Preventing problems is always better than trying to solve them. To truly protect your business, you need to embed strong reservation of title practices into the very fabric of your operations. It all starts with your contracts. Don't just download a template from the internet. Invest in getting your terms and conditions of sale drafted by a commercial solicitor. They will ensure the wording is robust, up to date with current case law and tailored to your specific industry and products. Crucially, they will ensure you have a properly drafted all monies clause, as this provides the most comprehensive protection. This initial legal cost is an investment that could save you tens or even hundreds of thousands of pounds down the line. Next, you must overhaul your sales and onboarding process. Every new customer, without exception, should be required to sign and return your credit application form before you grant them credit or supply any goods. This form must explicitly state that they agree to your terms and conditions, a copy of which should be provided to them. This single step solves the problem of incorporating your terms into the contract. For ongoing sales, ensure your quotes and order acknowledgements state that all orders are accepted subject to your standard terms and conditions. Make it impossible for a customer to later claim they were never aware of your reservation of title clause. This discipline is not bureaucracy, it's your financial shield. You also need to think about the practicalities of identification. Review your products and your packaging. Is there a simple, cost-accessible way to distinguish your goods from a competitor's? This could be as simple as using a specific colour of pallet wrap, applying a sticker with a batch code, or ensuring your company logo is clearly visible on the product itself. For high-value items, individual serial numbers are a must. Your warehouse and dispatch teams need to be part of this process. Their records of what batch numbers were sent in which shipment are the critical link you will need to prove your claim. Make it a standard operating procedure. Finally, a word of advice. Act swiftly and maintain good records. This isn't just about dealing with an insolvency. It's about good business hygiene. Keep your accounts up to date. Chase debts proactively and keep all your contractual documents in an organised, accessible file. Quick action and meticulous records are your best defence. When a customer does go into insolvency, having a strong reservation of title clause and the evidence to back it up puts you in a position of power. It allows you to reclaim your assets and minimise your losses, enabling you to focus on your business's future rather than dwelling on a past bad. It's about being a smart, prepared and resilient business owner. That's how you succeed in the long run.